Welcome to our Japan Power Procurement webinar. Our speakers today will be Peter Wygand, Skipping Stone Chairman and CEO, and Masahiro Yamashita, CEO at Enebuyer. Let's get started.
Thank you, Nancy, and thanks everybody for attending. I'm going to basically go through, you can see the agenda, I'm not going to read it to you. I'm going to kind of go through this fairly quickly, not trying to talk too fast. You are going to get this in an email, so I'm not going to talk to every slide. Then I'll turn it over to Masahiro to talk to you about, as a customer, what can you do with all this stuff? Next. So let's start with an overview of how the market's deregulated. Keep going. First, let's talk about the market size is actually much bigger than most people in the world think. It's the 5th largest market overall by demand and supply. But more importantly, from a deregulation standpoint, all 85 million meters or customers, if you will, in Japan have the ability to choose from somebody other than the utility if they want to. That compared to the US, which is about 27 million, it's basically triple, because as we all know in the US, there's many utility markets that are not open for competition, unlike Japan. Next. So most people remember the Fukushima tsunami that happened back in 2011 in Japan. Is called the Great East Japan earthquake. As a result, most people are aware they turned off all the nuclears in Japan and scrambled for every kind of power they could find to keep the lights on, which they did. However, that meant the prices increased by 40–50%, depending on who the customer was. So the answer by the government was to basically liberalize, or what we call deregulation everywhere else. So that law was passed in 2013. 2015, OCTO, which is basically Japan's single ISO, kind of like the PJM for the whole country, or ERCOT for the whole country. That was formed in 2015. And in 2016, full choice, if you will, started. So megawatt, but the futures market for TOCOM, owned by the Japan Stock Exchange, started in 2019, followed a year later by EEX. But in 2020, the utilities formally split up, and I'll explain how that works in a bit. And then in 2021, the carbon neutral laws were passed, and the renewable feed-in premium rule was passed a year later. And now, finally, you can start doing power purchase agreement and fixed price hedging type products that Masahiro will get into a lot more. So there's still a lot of market share to get, as you can see in the bottom. There's only 21% of the market has actually switched, and most of the industrials have not, but they will be. So next. So there's basically, this is very similar to the other global markets. The retailers sell to the customers. Like ERCOT in Texas and some markets in Europe, the retailer actually collects the utility charges. So you get a single bill, not one from the utility and one from the retailer. The utility itself has been split into 3 main business units. Transmission distribution, that no longer supplies power. They have a same rate for all customers. They call wheeling agreements. The generation, which they're required to not just sell to the retail sisters, but also sell into the market, either that or sell bilateral. The spot market physically, which is JEPIX, which is currently about 40% of the market share of all the generation. 2 primary markets, day-ahead and real-time, plus a renewable credit auction. There's some few other ones in there too. OCTO, the ISO, they've centralized all switching and meter data exchange happens through OCTO nationwide. All physical scheduling happens through OCTO nationwide. And Japan's been smart. Everything's XML, so it's much easier than many other markets. And all the customers have a smart meter, so that you get 30-minute data for pretty much everybody in a history. Then you get the 2 futures markets split into the East and West. And both markets have had substantial volumetric increases. Next. So the market participants, you've got one regulator, unlike many markets, especially the US, with many regulators, depending on where you are. There's one for everything in the power markets and gas markets too. There's 10 utilities, there's over 1,000 independent generators. There's several wholesale markets, Jeff, if we talked about Octo. EPRX is the balancing market run by the utilities, the futures, if we will. And then more importantly for end use customers, there's over 700 retailers in the market and 30 balancing groups, which primarily serve the little retailers, the smaller retailers for scheduling and balancing, that sort of thing. And there's over 150 traders, and that's growing. In the last couple of years, there's over a dozen non-Japanese firms like BP, RWE, Shell, Macquarie, and others that have entered Japan and really made a big difference in liquidity. Next. So this gives you some idea of the spot market. It's become very liquid. The blue background, if you will, is the trading volume, which is again about 40%. And the orange bar, the orange line at the bottom, I took the Tokyo market. You can see the big spike in the middle was around severe weather. Prior to that, it was pretty stable. After that, it's not been stable at all. You can see the Ukraine, Russia. So it's been volatile. This slide was done in at the end of March. Since then, it's been even more volatility. Next. So net zero, what most people call it the net zero. Of course, Japan calls it Act on Promotional Global Warming Countermeasures because they like long names, I guess. So that was passed in 2020, revised in 21. The two main things out of there is they want to reduce the GHG emissions by 2030, 46% below 2013, and zero by 2015. Very, very aggressive goals. So they now have in this SHK system, the 13,000 industrial customers must report by July. And the reason for July, in Japan, most companies' fiscal year ends March 31st. So they're doing their financials and so forth the next quarter, which ends in July. So in addition to that, they have the Act on Rational Use of Energy. We call it energy savings, which we revised just a year ago. So there's 12,000 customers, more or less the same as the 13,000 customers above. They not only have to report their GHG in July, they must have an energy manager, which you can outsource to somebody like Anabuyer. And it requires a reduction plan each year, minimum of 1%. Next. So the government has reduction targets. I'm going to focus on the yellow ones. So the commercial industrials get the brunt of this, other than EVs. And what this really is they're driving commercial industrial customers to buy the renewable powers under the feed-in premium. And that'll make sense as we get into the renewable forecast. Next. So let me talk a little about the GX League, which was launched a year ago by METI. So any company can join as long as you have a Japan corporate entity. So if you're in Japan as a factory or as a customer, most likely you have a Japan company and can join, which I think is very important. This is a very influential group as far as how the rules work and having a voice in what happens. So there's currently 800 members, and it's probably going to grow. So the GX members, as you can tell, must participate on a voluntary emissions on the JPX J credits. My view is voluntary now. Within a couple of years, it'll be mandatory. It's a get started voluntary wise. You can see the timeline down below. Next. So there's a mandatory disclosure of your emissions. TSE is Tokyo Stock Exchange, because it's simpler to say. So a prime market company, a listed company, are the bigger companies in Japan. They're the ones that have to establish the policies and disclose the company's initiatives, what they're doing to reduce the GHG. And they are following or will be following, if not fully implemented yet, the TCFD international frameworks. So that you can see down at the bottom, there's a Sustainability Standards Board, and they're adopting the ISSB 1 and 2 standards. Next. So a little bit different because I talked about MEDI overseeing the power and gas markets. The Ministry of Environment oversees the GHG and emissions. So sometimes there's a bit of arm wrestling between the two ministries as to how things are going to work. But one of the things you like about Japan, when they decide and they give you, it gets implemented pretty quick. So it's not like other markets where they go round and round trying to figure it out. So this threshold of the key attributes for emitters, that's really not a lot of emissions. I know it's the conversion of kiloliters of crude, but there's basically three calculations. What you use for fuels, whether you're using oil or coal or gas or whatever. So that's the CO2, the non-energy, which is basically if you're manufacturing and you're emitting emissions, that's that part. And then there's 6 other categories, a wide variety of all kinds of things. So you can adjust the emissions by purchasing of green certificates or green credits. Next. So the credit markets in Japan are a little confusing. There's a lot of meetings and so forth to kind of simplify this. So there's 4 kinds basically. There's a chart here. Feed-in, FIT means feed-in tariff. We'll get into that a bit later. So Octo issues those, and that's only based on feed-in tariff renewables, and JEPEX has an auction for those, so the NFCs. That's a fairly robust market, but not a lot of volume yet. Then the non-FIT, which is done by the generators, there's not really a whole lot of that traded. The green electricity certificate registered by the user, mostly biomass and self-generated renewables. That's traded bilateral. There's no exchange for that. And then the new kid on the block, J credits by the Tokyo Stock Exchange, JPX. So that's issued either by companies that have reduced beyond their targets or the government. So that's the one that we believe will be the go-to or the standard for corporates to comply. We believe it's going to be J credits, just a matter of call it maybe 2 years at the most. Next. So MEDI has set generation targets, and then skipping stone in the yellow. We have our own view because we think the targets are very aggressive. They want to turn back on 22% of the nuclear. That's behind schedule, as you can imagine, lawsuits, all kinds of issues of getting these things back on. So it's not that the government doesn't want it to be, it's just taking time. Coal is in reduction. There's new rules to start retiring those. We don't think, on our view, in 2050 they'll all be gone. I just don't see how they run it without something, especially in the LNG gas-fired. As you can see, the current mix, it's the predominant fuel, that and coal. So those two commodities drive power prices currently. Oil will definitely go away. Hydro is pretty well developed in Japan. It's not like some huge waterfall nobody's done yet. So there's very little, if any, there. The renewables is obviously the huge growth. And hydrogen we put in for something. Next. So FIT to FIP. So feed-in tariff had been run up until 23, where the price for developing wind or solar or whatever, or biomass, was set by the government, MEDI in this case. Then people applied for the auction to see who won to develop a product, the project. The offtake was simple. The utilities were required to buy it at the MEDI, the defined price. That went away in 2023, and now you had feed-in premium. So a couple of big differences. That's based on JEPEX spot plus a fixed premium set by the government, or a PPA or VPPA with a corporate, where you can do a multi-year fixed or something similar, as opposed to having a monthly market price. Most renewable developers we're aware of in Japan would rather have a corporate PPA because it's hard to finance a project based on a spot market. So there is a penalty for imbalance. So that means that the generator or a retailer or whomever is going to manage it has to schedule it and match supply and demand, whether it's bid in the market or to an end user. Used to be the utility just took whatever you made and that was it. So off-taker risk, utilities are not required to buy it anymore. And the few deals we've seen in the last year and a half, I don't think any utilities bought a feed-in premium renewable project. So the bottom line is the government, between the net zero laws and the corporate GHG and all that, and the change to feed-in premium are really driving the corporates or the customers to be the buyers for renewables, whether that's because you're required to reduce or, the generators have to sell it this way. Next. So there's the big push onshore solar. There's still room to develop, but it's slower. Onshore wind there's already a good bit of it. The big push is offshore wind, and you can see from the map there's a lot of projects. The reason I put the big 1 and 2 down at the bottom is that's Tokyo and Osaka, respectively. And you can see most of the offshore wind isn't anywhere near those cities, which is 20% of the population. So the key here is they need transmission to be built from these sites down into the population centers, kind of the central south to Japan. It's been planned, but nothing's been built and there's no financing. In my experience, in other parts of the world, even if you got it planned and financed, it could be a minimum of 10 years to build this or even longer. It's not just transmission, you got to upgrade the grid all the way along the way. And that's why our forecast on how much renewable there will be is lower than Japan's forecast for 2030 and 2050, simply because of the transmission issue. Next. So the renewable supply forecast under feed-in premium, this is different than what's already there. This is the gray bars. So it's definitely going to keep growing, and it has been. The yellow at the top is feed-in tariff that converts to feed-in premium. There's a program the government would like you to switch or convert. And we think as corporate PPA prices rise, you'll see some amount of conversion from feed-in premium to, or feed-in tariff to feed-in premium if they get a corporate customer. Next. So the demand is also growing primarily because of the net zero and the government push to GHG reduction for corporates, among others. So there's a low in the orange and a high demand in the gray. Next. This is a little confusing because there's two data sources on one slide, but I'm going to focus on the far right. 2028, we're expecting a shortfall, no matter, without doubt, in our view, either a low amount in gray or the high amount in the yellow. The point here is if you're going to meet reduction targets by 2030, and you're going to do it with off-site renewables, a PPA or VPPA, you need to get started now, because most of these deals take a year or sometimes 2 to complete. So the rush, the gold rush, if you will, for renewable deals has just started in Japan. I think last year there was 20 deals, none of them major. And then you have some large corporates that are actually buying entire wind farms. So those are not part of this. So I guess the point out of this slide is if you're gonna offset GHG with a PPA or VPPA, you need to get started now. Next. That's what I have. I'll turn it over to Masahiro.
Thank you, Peter. My name is Masahiro Yamashita. Please call me Masa. As an energy advisor, we assist companies in selecting the optimal electricity retailers and energy plan for their power procurement needs. Additionally, we provide guidance on procurement of renewable energy and environmental attributes. Peter has already explained Japan's electricity market, Japanese government effort related to global warming, and the regulatory framework. So I will discuss options for electricity procurement in Japan a specific decarbonization method that companies should consider during procurement, and the state of environment attribute market. Next slide, please. This table illustrates the cost structure of electricity plant in Japan. Understanding the structure is important when selecting the most suitable plant. Japanese electricity plant consists of three main elements: basic charges, electricity usage charges, and renewable energy levy. Among these, the renewable energy levy is determined by the government, so it remains the same regardless of the electricity retailer. Therefore, the key factors to consider when choosing a plan are the basic charges and electricity usage charges. Basic charges are calculated by multiplying three elements: basic charge unit price per kilowatt, contracted power expressed in kilowatt, and power factor discount. The basic charge is similar to demand charges in other countries. Electricity retailers can differ in the unit price of the basic charge, as it can include profit margin for them. The most significant difference arises from electricity usage price component. Traditionally, Japan's common electricity plant was the fuel cost adjustment plan, or FCA plan in short. It combines a fixed electricity consumption charge unit price with a monthly adjustment based on fuel cost. Recently, the market-linked plan, which adjusts electricity usage charges based on spot market price, has gained popularity. Both plans carried high price volatility risk because users only know the actual electricity cost after consumption. In contrast, we actively recommended the fixed price plan. While these plans are standard in many countries, they are fairly new in Japan with limited availability among Japanese electricity retailers. I will explain why this plan is gaining attention. Next, please. The left graph shows the variation in electricity usage charges for the fuel cost adjustment plan, including the fuel adjustment unit price. The blue bars represent a basic charge unit price, while the orange bar represent fuel adjustment unit prices. As you can see, fuel adjustment costs fluctuate, impacting monthly electricity usage charges. If fuel adjustment costs rise significantly, some electricity retailers may raise basic charge unit price accordingly. Fuel cost adjustment reflects fluctuations in imported oil, LNG, and coal prices in Japan. However, there is a time lag before these adjustments take effect. For example, the May fuel cost adjustment unit price reflects the average price from December of the previous year to February of this current year. The right graph plot JPEG spot price daily averages. In reality, the price fluctuated every 30 minutes, resulting from international LNG market prices, power plant outage, and rapid change in renewable energy supply. Opting for a market-linked plan means accepting significant price volatility risk passed on by the electricity retailer. Between 2022 and 2023, companies face substantial electricity cost increase regardless of the chosen plan. Next, please. What risks are likely to impact Japan's electricity prices in the future? Firstly, geopolitical risks play a significant role. Japan heavily relies on imported oil, coal, and LNG, making it vulnerable to global gas price fluctuations. While the Russian-Ukrainian conflict initially caused gas price spikes, ongoing tension in the Middle East remain a concern. Japan's specific risks include earthquake activity. Although a major earthquake occurred in Ishikawa Prefecture in January this year, there were 134 earthquakes with level 4 seismic intensity or higher in the past year. Additionally, climate change leads to unpredictable weather extremes affecting energy demand. Not mentioned here, but gaining attention is the surge in data center electricity demand due to the widespread use of AI. While the government initially predicted decreasing electricity demand until 2030, it now expects an increase toward 2040. Data center are the significant driver with an expected expansion of nearly 100 terawatt-hour in demand, which is about 10% of current electricity demand in Japan. Given this uncertainty, demand for risk hedge electricity plant is growing. Next, please. Okay, now let me introduce electricity plant with risk hedging features that we recommend. On the left side, we have traditional risk pass-through menus. On the right side, we offer risk hedge plan provided by contract electricity retailers. Examples include fully fixed price plan, block and index plan, and cap and floor options. As previously explained, traditional risk pass-through plans lack visibility into electricity costs for the next fiscal year, making budgeting challenging for the companies. Next, please. On the other hand, a fixed price plan allows complete price stability for up to 3 years with no fuel cost adjustment. User can choose different amount of their electricity volume to have the price fixed. While 100% is most typical, a smaller percentage, such as 50%, is possible. Additionally, you can opt to fix price only during peak seasons like summer and winter, when electricity price spikes are more likely. Currently, for simplicity, the majority of our customers choose a fully fixed price contract. However, as these new plans become more widespread, options similar to the block and index plan, popular in the United States, may gain popularity in Japan as well. Next, please. Another pricing plan option is having a price cap or market-linked plan to eliminate the risk of the market surging above a preset level. While market-linked prices are often the cheapest when nothing significantly occurs, they can spike dramatically when an unexpected event happens. Capping these spikes provides insurance. However, it's essential to note that this plan's availability depends on the service area and electricity retailer. For instance, while it is available in the Tokyo area, it may not be available in other regions like the Chugoku area and Hokkaido area. Next, please. So this page summarizes each plan. Keep in mind the fixed price plan's price can vary significantly among electricity retailers, so we recommend obtaining quotes from multiple companies. Next, please. So let's explore a case study. A client with annual electricity consumption of approximately 50 million kilowatt-hour signed a fixed price contract in January 2022 for the April 2022 to March 2023 consumption period. At that time, the price was based on the electricity futures price plus an additional 3 yen. Subsequently, on February 24, 2022, the Russian-Ukrainian conflict began, causing turmoil in the international energy market. As a result, fuel cost adjustment costs surged, leading to substantial increases in electricity usage charges. Fortunately, because this company had adopted a fixed price plan as a hedge, they saved approximately $1.4 million in electricity costs that they would have otherwise paid if they hadn't chosen the fixed price contract. Next, please. The next example compares the 3 components of the fuel cost adjustment plan and fixed price plans. While fuel cost adjustment plans involve complex seasonal and time of day electricity unit prices, Fixed prices plan are straightforward and do not include fuel cost adjustment. Typically, utility companies have significantly higher basic charges, sometimes nearly double the price per kilowatt compared to the other electricity retailer. This discrepancy is due to the large-scale operation of utilities, which contribute to higher fixed costs embedded in the basic charges. In this case, the company saved $600,000 by focusing only on basic charges. Next, please. So when we received an inquiry from client regarding energy procurement, more than 90% of the time, they also seek advice on achieving decarbonization. As Peter explained earlier, this is a primary reason. To achieve decarbonization, companies have several options, including selecting renewable energy plan, purchasing REC certificate called non-fossil certificate, or NFC for short, buying carbon credit, and exploring various alternatives. However, corporates need to consider both cost and the time required for implementation. Currently, many companies are actively adopting renewable energy plan and purchasing environment attribute, particularly through NFC. Renewable energy plan typically involves paying an additional fee ranging from about ¥0.5 to ¥1 per kilowatt hour on top of regular electricity plans. The fixed price plan can also be used for this purpose. While a certificate and carbon credit provide an easy way to achieve net zero, there's a growing trend among companies seeking additionality. Some are exploring self-generation or entering power purchase agreement known as PPAs for on-site or off-site renewable energy. Each option has its advantage and disadvantage in terms of cost. In this table, we have example of PPA contract price. However, these figures are from last year, and I believe they have increased due to the weakening yen and inflation. On the other hand, because the spot price on the JPX is low, off-takers are seeking lower contract price, resulting in wide bid and ask spread right now. Nevertheless, if electricity price surges again, PPA contracts are likely to advance rapidly. Next, please. When considering environment attribute, companies must weigh not only cost, but also their commitment to specific initiatives and national regulations. Many foreign companies operating in Japan are committed to initiatives such as CDP, SBT, and RE100. Additionally, a company needs to choose the right type of NFC or J credit, considering their specific goal. Next, please. For those unfamiliar with Japanese certificate market or J credit market, let me introduce them. On the left, we have the NFC market operated by JEPX. This chart displays the trading volume and price trend for NFCs derived from a FIT. FIT NFC transaction occur 4 times a year, which is August, November, February, and May, through multi-price auctions. Actually, today is the settlement day for the May transaction. The increasing trading volume reflects growing interest, but price remains stuck at the minimum price of 0.4 yen per kilowatt hour. This is due to the oversupply resulting from significantly more sell bid than buy bid. On the right, we see the market for J credit derived from renewable energy sources, traded on the Tokyo Stock Exchange since October last year, like Peter said. Although the trading volume is still relatively low, the market is gradually expanding with the introduction of market makers. J credit typically trade around 3,000 yen per ton of CO2, which translated to approximately 1.3 yen per kilowatt hour. Therefore, for offsetting greenhouse gas emission using certificate is cost effective. You will see this sudden drop in the price to half to 1,500 yen at the end of March, followed by the return to 3,000 yen again in April reflects. JPEG's announcement that they could separate biomass-derived J credit from general J credit, renewable energy, starting in April. So as Peter mentioned earlier, the addition of GX credit to the carbon credit market from November this year will likely impact J credit market. Next, please. Now, let's discuss Japan's unique situation regarding PPAs. In physical PPAs, Japan requires retail electricity retailers to be intermediary when electricity is transmitted through the grid. Unlike Europe and US, direct electricity exchange between power generator and off-taker is not allowed or not possible. Additionally, physical PPAs generally require the generator and off-taker to be in the same area. However, many off-takers are concentrated in the specific region like Tokyo or Osaka, which may differ from optimal renewable energy generator sites. While virtual PPAs are common in the United States, they are less prevalent in Japan due to the accounting practices. Companies adopting International Financial Reporting Standard, or IFRS, currently must use derivative accounting for virtual PPAs. In contrast, US companies are not subject to this requirement. Japan's accounting standard leaves room for interpretation, and many Japanese companies prohibit derivative transactions, hindering the widespread adoption of virtual PPAs. But nevertheless, this issue is likely to be resolved soon. In virtual PPA, physical electricity flow is not necessary, allowing off-takers and generator to be in different areas. However, this introduces basis risk due to potential differences in market prices between the generation area and the off-takers area. Next, please. Finally, let me introduce a new energy procurement model in Japan. While Japanese utilities typically visit companies to sell electricity, the European and the American approach involves using energy brokers. We have brought this energy brokers model to Japan, enabling companies here to procure electricity the same way they do overseas. Please reach out to Enebaya if you need assistance with energy procurement or meeting decarbonization goals in Japan. Thank you very much. Now we can begin to address some of the questions that have come in during our presentation. Thank you.
Some of these questions have come in during the webinar. First of all, a question for Masa.
Yep.
How does Enebaya decide on which suppliers to work with?
I think this is a very good question. First, we only work with a supplier which have a very financial sounding. So we always look at the balance sheet of this retail company. And second, we evaluate the supplier's capability to offer hedge pricing plans, fixed or caps. Third, we test their ability to be responsive in a timely manner. And fourth, we also review the contract language to look for clauses we doubt customer will be willing to sign for. So these four elements we always are looking at.
Thank you. This one is, I think, for Peter. Why do you forecast a renewable supply shortfall for corporate customers?
Good question. So onshore development has, well, first of all, I start with the feed-in premium for everything but the large developers of the balance sheet means you got to get financing. It's really hard to finance a project on a spot market basis. So they need a corporate off-taker. So the development onshore is slowed down partially for that reason, partially because there's now resistance by local governments and citizens about, not in my backyard, those people are out in force. Offshore, while the bids have been out, there's no transmission yet. So you have this sort of perfect storm of the renewable market is not near the market and it's slow to grow. If they're going to hit the 2030 target of 46%, and most of the offshore won't even come in until well after 2030, and yet you're driving corporates to reduce to 46% by 2030. It doesn't, the math doesn't add up. So there's why we think there's a shortage.
We'll go back. Masa, this is the one that has come in. How would you coordinate between our Japan facility staff and corporate HQ here in the US?
Oh, yes. We are able to work in both English and Japanese, so we can coordinate however you like, actually. I anticipate if it will work in steps or several phases. For example, like we get, either headquarters or the local team to review and sign the end-buyers agreement. This is the first step. And second, we work with the local team to gather data. We need at least like a 30 minutes usage data, for example. And then we discuss the purchasing strategy and requirement on perhaps and all parties, conference call or something. And then we do the RFP and review the finding with all parties and the suppliers contract likely with headquarters. So this kind of steps we can use.
Let's see. Peter, you show over 700 retailers on the market. Why so many?
Well, it's kind of the US version of the gold rush. When it opened up some year 2016, a lot of Japanese companies jumped in and said, well, I can be an electric retailer, not knowing really what that meant. So at one time we were over 850. Then the price spiked because almost all the non-utility retailers were buying spot market on a 30-minute basis and selling a monthly price, whether fuel cost adjustment or whichever. This is before the market price plans came into effect 2 years ago. So a lot of them went out of business from 850 down to 700. I predict it'd be like other global markets, there'll be consolidation further as the smaller guys can't really go into these fixed price products that we're seeing growing. So they'll consult. We think there'll be consolidation there. So I expect that number to shrink over the next 3 or 4 years.
Why should we consider fixing our electricity prices now? The current market seems really low. Masa, what do you think of that?
Yes. Staying on spot or maybe fuel cost adjustment price plan means you expect the price to remain low for at least maybe another year or more. But when prices are low, it is the best time to lock in some or maybe all of your load on the fixed price for as long as you can, for example, like 3 years. And we always provide some price information about like a futures price and fuel cost prices or maybe JPX price to the client, and the client will see, oh, this is the right timing to do that.
Let's see. This is a question that came in. Where can I purchase FIT-NFC non-fossil certificates? FIT non-fossil certificates. There, tongue twister. Masa, do you want to answer that one? Or?
Yeah, I can do that. It's a FIT non-fossil certificate. It's called FIT NFC. Can be purchased through 2 methods. The first one is a direct purchase. So company become a member of the JPX and non-fossil market. This is the market called non-fossil market, and buy FIT NFC directly. Second way is to use an intermediary. So you can purchase FIT NFC through intermediary agencies. So these are 2 ways. So while becoming a JPX member, involves cost and effort. And using an intermediary is, I think, much easier and recommended. And we can assist with intermediary purchases, but you need to know that FIT NFC resale is prohibited here in Japan.
And then let's see, here's another. The base price for the fixed price plan is said to be the electricity futures market. But the electricity futures market only allows trading up to 2 years in the future. Where will the reference market be when coming up with a fixed price for 3 years?
That's yours.
Yeah, I think he knows this the market pretty much. Yes, it's true. For 3-year fixed price plan, the reference market is not a power futures market, but LNG futures market instead. The electricity retailers that can offer a 3 years fixed plan have their own power plant and can generate electricity from LNG they procure themselves. So that's why LNG market is kind of like a benchmark price for this 3 years contract.
And, this might be a discussion one. I'm not sure. For plans with caps, how much did the caps cost?
Go ahead, Masa.
Cap price always changes based on the market condition and volatility. So it's never stable. But for example, I can give some example. In January 2023, when I talk with these traders, the cap price for 30 yen cap in the Tokyo area costs more than 3 yen. However, during the period from last year, like December to this year, February, the price also went down. So when our price significantly dropped, 20 yen cap was, I think, available for just 1 yen, I think. So given the current geopolitical situation, such as like a Middle East tension and increasing volatility in power futures market, so I think the cap are likely higher than those levels.
Peter, I think there are some questions that have come in that we just don't have time for. We need to go ahead and wrap up, but I know that you're both going to get in touch. I'll send you the questions and you can get in touch with the people who've asked them personally. Thank you so much for being part of our webinar. We appreciate your time and we'll see you in the next one. Thanks. Bye.
Thank you.